£100, that is all it takes to start building real wealth in the UK. Not 1,000, not 10,000, 100. And in this video, I'm going to show you exactly where to put it, why it matters more than you think, and what happens if you just keep going. Whether you have never bought a single share in your life, or you have been putting this off for months, this is the video that gets you started. Let us get into it. I know what you're thinking. Dex, £100? What is that actually going to do? And look, I get it. £100 doesn't feel like a lot. But here is the thing. Investing is not about having a massive lump sum. It is about building a habit, and it is about time in the market. The biggest mistake beginners make is not picking the wrong fund or choosing the wrong platform. It is waiting. Waiting until they have more money. Waiting until they understand it better. Waiting until the market looks a bit calmer. And while they are waiting, they are missing out on years of compounding, which we will get to in a minute, because the numbers are genuinely eye-opening. The platforms available to UK investors today have completely removed the old barriers to entry. You do not need a stockbroker, you do not need a financial advisor, and you definitely do not need thousands of pounds. You can start with just £1 on some platforms. So there is absolutely no reason to wait. Before you even think about what to buy, you need to think about where to hold your investments. And in the UK, the answer for most beginners is a stocks and shares ISA. An ISA, individual savings account, is basically a tax-free wrapper. Any money you put inside it grows completely free of capital gains, tax and income tax. So if your investments go up in value and you sell them for a profit, you pay zero tax on those gains. If you receive dividends, you pay zero tax on those too, as long as the money is inside your ISA. Now, outside of an ISA, you do get some allowances. For the 2026 to 2027 tax year, you have got a capital gains tax annual exempt amount of £3,000, meaning you can make up to £3,000 in gains before you owe any CGT, and you have got a dividend allowance of £500. So the first £500 of dividends you receive each year is tax-free. But those allowances are relatively small, and as your portfolio grows, you will be very glad you started inside an ISA. The annual ISA allowance for 2026 to 2027 is £20,000. That is the maximum you can put in across all your ISAs in a single tax year. For most of us starting out with £100, we are nowhere near that limit, which means you can invest your £100, keep adding to it over time, and the whole lot stays sheltered from tax. Right, so you want to open a stocks and shares ISA. Which platform do you actually use? There are loads of options out there, but for beginners starting with £100, I would point you towards three in particular: Trading 212, InvestEngine, and Vanguard. Let us start with Trading 212. This is probably the most beginner-friendly platform out there right now. There are no platform fees and no trading commissions on their stocks and shares ISA. The only charge you will typically encounter is a small foreign exchange fee of 0.15% when you buy assets priced in a foreign currency, which is pretty standard. You can start with as little as £1, and the app is genuinely slick and easy to use. For someone putting in their first £100, this is a brilliant starting point. Next up is InvestEngine. This one is specifically built for ETF investing, exchange-traded funds, which is exactly what we are going to be talking about in a moment. InvestEngine charges zero platform fees and zero trading commissions on their DIY portfolios. You do still pay the underlying fund costs, but there is no extra layer of fees on top. You can start from as little as £1 with fractional investing. If you want to keep things simple and cheap, InvestEngine is hard to beat. Then there is Vanguard. Vanguard is one of the most respected investment companies in the world, and their UK platform is solid. The fee structure is a flat £4 a month if your portfolio is under £32,000. That is £48 a year. Above £32,000, it switches to a percentage-based fee of 0.15% per year, capped at £375. The minimum one-off investment is £500, and the minimum monthly direct debit is £100. So if you are starting with exactly £100 as a monthly contribution, Vanguard works well, but if you want to invest a one-off £100 lump sum, you would need to use Trading 212 or InvestEngine instead. Importantly, all three platforms are regulated by the Financial Conduct Authority, and your money is protected up to £85,000 under the Financial Services Compensation Scheme. Okay, so you have got your ISA open. Now the big question, what do you actually buy? My honest advice for beginners? Keep it simple. Do not try to pick individual stocks. Do not try to time the market. Just buy a broad, low-cost index fund or ETF that tracks the entire global stock market. You get instant diversification across hundreds of companies in dozens of countries, and you are not betting on any single business. The fund I would point most beginners towards is the Vanguard FTSE Global All Cap Index Fund. This single fund gives you exposure to over 7,000 companies across developed and emerging markets. Everything from Apple and Microsoft to smaller companies in Asia and Europe. The ongoing charge is just 0.23% per year. That means for every £100 you invest, you are paying about 23p a year in fund costs. That is incredibly cheap. If you want to go even simpler and focus on the US market, you could look at an S&P 500 ETF. The Vanguard S&P 500 UCITS ETF is one of the most popular choices among UK investors, tracking the 500 largest companies in America. There are also options from iShares and HSBC with similarly low ongoing charges. The S&P 500 has historically delivered strong long-term returns, though of course past performance does not guarantee future results, and it is worth remembering you would be more concentrated in the US compared to a global fund. Either way, the key principle is the same: low cost, broad diversification, and a long time horizon. Drop a comment below and let me know. Are you going for a global fund or an S&P 500 ETF? I am genuinely curious where people are starting. Right, this is the bit that I think really clicks things into place for people. Let us talk about compound interest, because this is why starting with £100 today, even if it feels small, genuinely matters. Let us say you invest £100 this month, and then you commit to adding just £100 every single month going forward. That is £100 a month, about the same as a couple of meals out and a few coffees. Assuming an average annual return of 7%, which is a reasonable long-term assumption for a diversified global index fund, though not guaranteed, here is what happens. After 10 years, you would have contributed £12,000 of your own money, but your portfolio would be worth roughly £17,400. That is over £5,000 in growth on top of what you put in. After 20 years, you would have contributed £24,000. Your portfolio? Around £52,000, more than double your contributions. After 30 years, you would have put in £36,000. Your portfolio could be worth around £121,000. That is the power of compounding. Your returns start earning returns of their own, and over time, the growth becomes extraordinary. The single most important variable in that equation is not how much you invest. It is how long you stay invested. Every year you delay is a year of compounding you never get back. So start now, even if it is just £100. If you are watching this and thinking you want to understand more about how to make your money work harder, this channel is built exactly for that. We break down UK investing, ISAs, funds, and everything in between. No jargon, no waffle. If that sounds useful, subscribe now. There is a lot more coming, and you do not want to miss it. Before I tell you what to do next, let me quickly run through the mistakes I see beginners make all the time, so you can sidestep them from day one. The first is panic selling. Markets go up and down. That is completely normal. When your portfolio drops 10 or 20%, everything in your brain will tell you to sell and cut your losses. Do not. If you are invested in a broad global index fund for the long term, dips are just temporary noise. The investors who lose money are usually the ones who sell at the bottom and miss the recovery. The second mistake is trying to time the market. Nobody, and I mean nobody, can consistently predict when markets will go up or down. Instead of trying to buy at the perfect moment, just invest regularly. This is called pound cost averaging, and it means you automatically buy more on a regular, consistent basis. One good way to pound cost average is to pick a date each month in which you add money to your investment account and buy. You could even set up a direct debit to do this for you, which takes all emotion out of the process. The third mistake is ignoring fees. A platform charging 1% a year might not sound like much, but over 20 or 30 years, that difference in fees can cost you tens of thousands of pounds in lost returns. Stick to low-cost platforms and low-cost funds. And the fourth mistake is not starting at all, which, if you are still watching this video, you are already avoiding, so well done for that. So you have opened your eyes, you have invested your £100 into a global index fund. What now? First, set up a regular monthly contribution if you can. Even £25 or £50 a month on top makes a real difference over time. Most platforms let you automate this, so it just happens without you having to think about it. Second, do not obsess over your portfolio every day. Check in once a month at most. Investing is a long game, and watching the daily movements will just stress you out for no reason. Third, keep learning. The more you understand about how markets work, the more confident you will feel, and the less likely you are to make emotional decisions when things get bumpy. If this helped you, please give it a like and subscribe to the channel. It genuinely helps more people in the UK find this content. So what are you waiting for? You have got your £100. You know where to put it. Now go do it. I will see you in the next one.